a major country in crisis. I'm your host, Steve Metre, and thanks for joining me today. In our show today, they're dumping everything, and I want you to understand it's going to lead to an all-out economic disaster, one that's going to plunge the entire world into a deep recession. Now let's over to Bloomberg, where he picked today's story up with a headline as China sells record sum of U.S. debt amid signs of diversification. And this is only just one of the many factors now going on in the world's second largest economy, as everybody's looking to get out and dump their holdings fast, because what's happening in China is their economy is on an unstoppable path to the downside. And I want you to understand why they're selling their securities, but let's take a look at what the news says, because Beijing offloaded a total of $53.3 billion of treasuries and agency bonds combined in the first quarter. And this, of course, Belgium, often seen as a custodian of China's holdings, also disposed of $22 billion of treasuries during that period, giving everyone the impression that China is trying to move away from the dollar. But a lot of people don't understand, how does China get dollars? Because remember, we're not in a gold standard anymore. We're on a dollar reserve standard. So the goal should be to accumulate dollars. And when you have too many dollars, you recycle them into treasury securities. And China gets them through global trade. Now, the problem is they have dollar denominated debt. They have things they need to buy with dollars. And when they start to run out of those, well, they have to do the unthinkable in this case, and that is dump their treasury securities in a big way. And again, it all comes back to global trade. Here we can see the imports of goods and services into the U.S. This shown on a year-over-year rate change in blue. And what I want you to note, against the nominal broad U.S. dollar index, when you see global trade contracting into the U.S., what happens, it usually sends the dollar higher. In fact, you can see almost each and every time. And we note that imports into the U.S. are likely to slow in the future, because what we can see with the U.S. consumer is their total compensation in terms of wages and hours continues to decelerate. Their debt levels are high. Inflation still remains elevated. They're tapped out on their credit cards. They're tapped out on those buy now, pay later loans. They're just not in a position to consume, which suggests that we're going to see demand for imported goods fall, which means dollars in China are going to be hard to get, which is again why they're dumping treasuries in a big way. As China's selling both, despite the fact that we're closer to a Fed rate cut cycle, and this makes absolutely no sense. There should be a clear intention of diversifying away from the U.S. dollar holdings. And that's the belief here, is that China is selling these securities because they want to get away from the dollar. And that doesn't make any sense, at least on the forefront, because if you think about it, the U.S. is the largest importing nation in the world. China is the largest exporting nation in the world. You think those two need to go together, because if China diversifies from the dollar, guess what? People in the United States only pay for imports in dollars. It doesn't make sense. There's nowhere else for China to send their goods but here. They're not looking to get away from the dollar. They're in desperate need of dollars. That's the key here. And what we can note is that China's selling of U.S. securities could speed up the U.S.-China trade war if it resumes, especially if former President Trump retakes the White House. What do you think? Do you believe that if we see a return of former President Trump to the White House, that we're going to see a resumption of the trade war? Or are we going to just see things where they're at? Or is he going to bring down those walls? I'd love to know what you think, because here's what we can tell is when you see headlines like this, you could be making money. And wouldn't it be great when you see wheat gains as dry weather in Russia exacerbates crop concerns, that you could say, how did I know? I should have bought wheat and made a fortune. And sure enough, we showed our subscribers, and they are. We showed them with both of our reports how to buy deep down here when no one wanted to buy wheat. In fact, they wanted to sell it, and it has taken off since. Look at these massive returns. This is as the close of business yesterday, 24%, 23%, 21%. How do we do it? Well, we have two ways. We show you the machine positioning. We mount a historical overlay against how the machines trade. And when they get in deep short positions and price moves against them, they have to short cover. We give you that alert, tell you when to trade. We even put videos to show you how to do it. Maybe you're a technical trader. That's our Momentum Timer Pro. But you find yourself trading in and out and all over the place. We smooth it out, give you nice, clean signals and videos on how to trade it. Here's the best part. You get 30 days to trial both of them. Links in the description. Start making money trading and start looking at those headlines as money in your pocket, because if this was all about the Fed, then China should hang on to those treasury holdings because they're about to go up in value as the Fed cuts. We see here the effective funds rate in blue against 10-year treasury yields. So if the Fed indeed cuts, those yields on those bonds that China holds are going to drop. The value is going to go up. In fact, we note the values are likely to go before the Fed cuts. So any notion here this is about the Fed is not true. It's all about global trade. It's all about the dollar shortage. It's not about diversification. There's another factor here that many are overlooking. And China and countries with close ties to it have increased their holdings of gold and foreign exchange reserves since 2015. And this is just adding to that whole story of, well, they're trying to get away from the dollar. Well, hang tight. There's another reason they're accumulating gold here. I'll show you. And while countries in the U.S. bloc have kept them broadly stable, what we can see here, this suggests gold purchases by some central banks may have been driven about concerns about sanction risk. And again, you talk about global trade here. China has nowhere to dump all of their goods. In fact, they're trying to get rid of a bunch of overproduction, and the natural place is you send it to the one country in the world that consumes more than everyone else. That'd be the United States. And again, the United States only pays in dollars, so if you diversify away from the dollars, well, we're not going to start paying in yuan or any other currency. We're going to pay in dollars. They can't escape that, particularly in a dollar reserve world. The issue here is why they want gold is it's because of the yuan. As China allows yuan to drop as outflows and dollar tested PBOC's grip, and this is more about their own consumers and trying to show everyone, look, it's okay if the yuan goes down a little bit because, look, we've amassed gold, we have safety to back our currency. This is what it's about. Nothing, again, to do with displacing the dollar. The PBOC has been facing a constant battle to find the optimal pace of yuan weakness that's conducive for growth without triggering market panic or capital outflows. And you start to see those two words, market panic and capital outflows. Again, you start to talk about it's not just China dumping treasuries. We're going to look at other people dumping Chinese assets. And there's a really good reason. They're watching the yuan spiral down. It's telling you demand for that currency is plummeting. It's telling you the economy is getting weaker. And what we've seen throughout history, when major currencies start to get unhinged, well, it leads to economic turmoil in a big way. Former Chinese officials said last week the nation should relax its control of the yuan as the current focus on keeping the currency stable has limited the scope for possible monetary stimulus. That's a problem because there's this belief that central bankers have control of their own currency, which of course we know they really don't. But the idea here is China desperately needs to stimulate its economy. It needs to create internal demand to deal with all this production to grow its economy, yet they're afraid to because they believe it will lead to further yuan weakness, and that's causing, of course, more people to dump everything. As foreign investment in China now drops for the fourth month in April, and this is dangerous because if you look at how China gets dollars, well, the big one is through trade. Another one is through foreign investment. They love it when money flows into their country because when it heads out, well, it means asset prices and everything else are going to come crumbling down. As foreign investment in China slowed for a fourth straight month in April, underscoring Beijing's struggle to attract more overseas funds to boost its flagging economic growth. And why would anybody want to invest in China right now? If you look at this, we're on the cusp of a trade war escalation. Their economy is slowing down. They're seeing deflation. Their currencies just continuing to decline. They're stumping their treasury holdings as if they're panicking. Again, you think about their treasury holdings. This is their savings of dollars. They're selling them. This is a problem. Everybody can see it except maybe Beijing. And here what we note, the new actually utilized foreign investment in China was 58.5 billion yuan last month. That was down 36% compared with the same month in 2023 and the second lowest result for any month since late 2019. But it gets worse. The release comes after separate data from the central bank showed the value of inbound new investments fell a whopping 56% in the first quarter. Capital outflows have also worsened in April, underscoring headwinds for the yuan amid a weak domestic economy and uncertainty over the Federal Reserve's rate trajectory. And again, I noted, of course, why do people want to get their money out of China? It's not just due to the economy, it's the fact they could earn higher yields elsewhere. And what you see is money flowing into the U.S. And in a dollar-centric world, that's not really what you want. Now, if money is going to flow into the U.S., you need it to go into consumption and demand so those dollars can eventually flow back throughout the world. Here's the problem. The Fed's got rates so high relative to the rest of the world, they're flowing into dead assets, into the banking system where those dollars aren't moving. And now we're seeing, again, more reasons why people want out of China as they hint at a 25% card tariff as deadline for the EU probe looms. So now we face an all-out trade war as China is trying to unload all this overproduction. And you think about this from a political move. This was smart. You see your factories slowing down. You see global demand slowing down. You just tell them to crank it up. You force loans upon them, tell them to drive their production, and then you hope to send that across the rest of the world and export deflation until you find out the rest of the world doesn't want it, and now you find yourself in a trade war. As China's retaliatory trade investigations and warnings are not deterring the EU, as Brussels is eager to send a strong signal to Beijing with its EV probe that the EU will counteract Chinese subsidies and overcapacity. And all of a sudden, we went from a world of not enough supply to now too much supply, to a point where governments around the world are starting to move into protectionism mode. And you don't do this when the global economy is prospering because there's enough demand from everyone to deal with the supply. But when you start to run into a case where demand is plummeting, supply is growing, everyone starts to protect their industry because they know the lowest cost producer will eventually cause major job losses, business failures in other countries. And we continue to see now demand continue to fall, even in the oil markets, as oil drops the lowest over 3 months despite OPEC Plus outlook. And remember, everyone said oil was going to go to triple digits. We said not a chance. This thing is not going to happen. Consumers can't afford it. The economy can't handle it. And sure enough, there's definitely a bearish sentiment now in the market. We're seeing a pricing out of the geopolitical premium, and there's growing concerns on the supply and demand balance. And that is key because a lot of people say, wow, war is bullish for oil. Well, it's usually only bullish for a week or two until it comes crumbling back down because it's all about economic fundamentals, and the fundamentals are weak. In fact, Brent crude dipped below 81 a barrel, while West Texas Intermediate is now bound down near to 76. Both benchmarks are set for a weekly loss, but the Memorial Day weekend is typically seen as the start of the peak driving season in the U.S., boosting gasoline consumption, and investors, along with us, we're going to be watching to gauge the demand outlook because right now the prognosis is U.S. consumers cannot afford higher gas prices. They don't have the money to spend. And on top of that, if they're going to spend more money on fuel on Memorial, it means they're going to cut their spending in other areas. They just don't have the spending power, likely to lead to further hours cut in the labor market, more job losses likely to happen in the coming months. And another reason everyone's wants out of China, well, it has to do with shipping. As Southern Container Crunch sends ocean freight rates soaring, setting off a global trade alarm bells, and they're ringing from the Far East into the U.S. West Coast. It is likely spot rates will surpass the level seen at the height of the Red Sea crisis earlier this year, which demonstrates how dramatic the recent increases have been. And so you think about why people want to pull out of there, and they want to protect their domestic consumption. It's really simple. They know that prices now are headed higher. A lot of countries want inflation to come back down. They want those central banks to cut because the risk is if we stay at these elevated tight levels, we're going to see every country, one after another, slip into a central bank recession. They don't want that to happen, but right now it looks like a foregone conclusion as spot rates have fallen after the sharp rise triggered by the Red Sea tensions in early 2024. But at the end of April, they began spiking as much as 1,500 on average on routes to the U.S. coast, and now some of the highest contract rates charged by shippers are double the rates of a month ago, and that's going to feed right into consumer prices at a time when consumers cannot afford higher prices. So you think about this. They're going to spend more money on fuel during the Memorial weekend and in the weeks and months to come, less money on discretionary spending, and then when they do go to the store, they're going to see those higher prices and have to cut back in a big way. The recent increase in demand for exports out of China, together with a dip in the number of repatriated empty containers, means shippers are starting to find empty equipment hard to come by at some export hubs, even though demand levels are not extremely high. So this is key. Demand is not high, with vessel capacity already stretched thin. The recent increase in demand is enough to push rates up, and that added to the lack of containers is only helping push them up even higher. But get this, regardless of what the headlines about the economy might say, and this I have complete disagreement with, consumers are shopping and retailers are making sure they have merchandise on hand to meet demand. The restocking may have just started. This from Jonathan Gold, the Vice President for Supply Chain and Customs Policy at NRF. Well, Jonathan, I couldn't disagree more with you. Yes, maybe businesses are restocking here, but what you can see going on in China is everybody wants to get out. They know the second largest economy is about to plummet in recession. If they go, they take the rest of the world with them, and we're already seeing pullback on U.S. consumers because their total compensation continues to fall and their savings rates are evaporated into nothing. It's now just a matter of time before it's all-out disaster. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.